All right, YouTubers, what's going on? This is Ryan, aka Cantor and Clark with BlockRoots, and it is 5:03 p.m. New York time on Thursday, April 9th. So the markets are closed now for the weekend. Equities markets and futures are closed, and this is one of the advantages of Bitcoin is that you can trade this market 24/7. So this is especially advantageous for institutional traders or hedge funds, okay, to be able to still siphon money when other markets are closed. And especially since the crypto market is super inefficient, it makes it that much more attractive. So just trying to ring out some selling points for crypto right now because it could use some help. And when I say crypto, I primarily mean Bitcoin. I think that the proper term would be to refer to Bitcoin as synecdoche for crypto. And I think synecdoche, if I'm using it correctly, is when you refer to a part to reference the whole. Sort of like saying, instead of saying, driving your car, you say you're taking out your set of wheels. So Bitcoin pretty much represents the entire crypto market right now. But anyway, we have a few things to go over in this video. Okay, before we get into anything, just as a reminder, as long as you are subscribed to the YouTube channel, if you leave a comment below, you'll be automatically entered in to win $100. This is not a contest, so it's not really contingent on you saying anything in particular. It's just a lottery. We hope that you have something of substance to say. There are some people that like to respond with just a bunch of random characters, and rules are rules. So it's a lottery, and we just enter the YouTube hyperlink into a random comment generator, and essentially it's going to pull the winner from that. So we're going to talk about a few things in this video. Today was a pretty big day, again, for the market in terms of big day for the economy being negative, but for the market, it's been a positive day throughout the week, and that's Thursdays when the jobless claims report comes out, and this is an indication of how negative things are, and markets are irrational, and the market continues to pump based on this release. It's almost like the expectations are that it's always going to be that much worse, or it's going to be way more negative than it actually ends up being, even though it's a tremendously negative number. So the market continues to pump afterwards. So I don't know what they're expecting. If they're expecting just total annihilation of the economy, and anything short of that is a good reason to pump, hey, maybe that's it. But today was a horrible day. But the Fed is going to continue to just backstop everything, which, QE and the Fed put all the way, pretty much never fade the Fed. That's a lesson that I've learned in the last 10 plus years trading at this point. I'm going on, I think, 13 or 14. I'm 35 now, so going on, I think it's 14 years now, and you just don't fade the Fed. So anyway, we're going to talk about my trading style really quickly. I'm going to get into that because there is some level of confusion sometimes when I make, well, there's not a level of confusion, but I'll get into sort of the more granular aspects on YouTube videos, and I'll forget to really touch on the higher time frame. And I think we're at a key point right now where it's worthwhile for me to get into, where I will look for longer term positions, because I know a lot of you guys are not really caught up in some of the more technical aspects of my trading style, such as order flow, for example. It's way more atomized approach to the market, and I think that we're at a key level right now where I could sort of key you in to when I am going to be taking longer term positions, and we just happen to be at that level right now. So I'm going to break down my higher time frame swing approach versus my normal sort of intraday trading approach. And this all has to do with relative location to major market structure. Areas where I say that we bring a lot of participation into the market, I would refer to them sometime as key inflection points and so forth. So we'll talk about that. Obviously, we'd be remiss without mentioning what's going on in traditional markets right now. Markets are closed, but it's been just, if you want to look at this market in isolation right now for the past few weeks, it's been great, right? But I don't think that this is, I think that if anything, this is an indication that the fundamentals are really detached right now from price. And this ties into the way that I trade, right? When we're talking about using our distribution through time and establishing value areas and taking advantages of those times when price is detached from value. okay, and sort of arbing that disconnect. So there's a major disconnect right now in traditional markets, and I think there's a major disconnect between fundamentals, which has been the case for the, people would argue that for the past few years that there's been a disconnect between fundamentals and price, but now it is patently obvious, right? Now we are looking at just an economy that, for lack of better words, looks like it has a shit future, right? This amount of people every single week applying for unemployment is a really negative sign, and it has a pure indication of the actual structural and mechanics of what's taking place under the surface. All right, this is not just speculation anymore. This is very much front and center. So we'll talk about what's going on, talk about what's going on with the coronavirus, because again, that is something that is, as long as there is no vaccine, as long as there is, this lockdown occurring, it's worth covering, right? This is still, as even though the numbers are improving, and I think that you could use New York as a reasonable barometer if you're in the United States, although there is the argument that it's going to be spreading to other states. That remains to be seen, obviously, but there is some improvement worth mentioning. All right, market very likely is responding to that. A few days ago I mentioned that Cuomo mentioning that the cases were beginning to plateau. We might see some relief from that, and sure enough, that came. So yeah, let's get right into it. All right, so first things first, okay, when you're looking at my setups on, and I have to remember that I'm not always talking to someone that is trading my particular style, right? So when I'm sharing charts on Twitter, for example, you'll see how I break down my charts, and you'll see a lot of this composite stuff, range composite, value area composite, and essentially what I'm doing is I'm compressing. Let's say we have 4 days, we have multiple back-to-back days, inside days. What I'm doing is I'm taking this range that occurs and I'm compressing it, and I'm beginning to identify what the value area is over that period of time. All right, so if we see, if you're just looking at candlesticks and you had multiple candlesticks that were looking like this, right? This would be an inside day and then maybe another inside day and then an outside day. But ultimately, the distribution through time would probably be pretty similar, all right, in terms of where we spent the most amount of time, where the value area was distributed, okay, or where the value area was located. So what I'll do is I'll take this range that's painted and I'll begin to establish a value area for that longer period in time. So I have an idea of where the value area high is, where the value area low is, and then this is going to be the area that I'm going to be taking advantage of price auctioning within. All right, so if I'm looking for mean reversion trades at the high and the low, and this is also going to be sort of the threshold that I'm going to be looking towards to identify not only exhaustion that would be useful for mean reversion, but acceptance through. So when I see that we are forming some type of consolidation or forming some type of range, well, the market goes from a period of consolidating to expansion, trending, and then a period to consolidating again. So I'm looking for acceptance through these areas as well. And these are it's just a distribution, right? And it shows where the market has favored over time from, again, a time standpoint, and I'll use volume as well to confirm this. Okay, so a time-based distribution is nothing without a volume-based distribution. You have to see that volume is always confirming price. So these levels are what I'm going to be looking for when we are sort of in no man's land. These are what I'm going to be looking to trade when we're in more or less no man's land, when we're between major areas of market structure. So what I mean by that is when we look at the higher time frame chart, for example, all right? So now we have our key weekly. Let me just change that ink size because that is going to drive me fucking nuts. Excuse my language. I just hate when that happens, and I have no idea how it happens because it happens on its own. There's a ghost in the machine. So when we're between key areas of market structure, all right, I don't get into higher time frame, longer duration positions, okay? I wait until we're in relative proximity to these key, what I refer to as key inflection points or places where we'll see a lot of participation come into the market. Generally speaking, when the trend changes, this is going to be an area where you can expect a lot of activity and participation to occur. For example, there's going to be a lot of larger traders defining their risk, defining their bias around these areas. So I want to be with the major flows. And if anything, I also want to be able to define my risk reasonably as well. Okay, and I don't want to marginalize it by preceding that part of the sentence with if anything, because that is probably one of the most important aspects. All right, so excuse my phrasing, but ultimately what this allows me to do is define my risk in a, I'd say that if you're in the middle over here, you're defining your risk in a suboptimal way, and you're just taking suboptimal positions if you're looking for longer term positioning, all right, and you're in the middle of major market structure, okay? This is where I will trade mostly intraday, where I'm identifying these balanced areas, where I am identifying sort of these microstructural areas that occur, and I'll be taking shorter duration trades because of that. All right, because if anything, these are the small perturbations that occur within the major waves. All right, and I say waves, I don't mean LA waves. I just mean the market does move in a sort of fractal way where there's smaller movements within larger movements, and all I'm doing is basically taking advantage of the mean reversion that occurs, the small behavior that occurs between these larger structures until we're closer to a larger structure and I could put on a longer duration trade. All right, just to keep it as simple as possible. Okay, now the thing about higher time frame market structure is a lot of people, okay, across the spectrum, across different strategies, different styles, are going to be informing their bias around these changes. Okay, so when you have a major area of market structure that is lost, for example, to the downside, then this will inform the bias of your position traders, your swing traders, your intraday traders, less so your intraday traders. Okay, if you are in relative proximity to this higher time frame location, just know that if you are an intraday trader and you're taking a position in close proximity to this, that you have other time frame participants working either with you or against you, depending on what position you're taking. Okay, so this is an area where I would say that you are either with the flow or against the flow, very much so. Okay, versus being over here. All right, because again, this is an area where you're bringing other people into the market that might not necessarily be active until we come into these major swing points. So major market structure, just consider that your larger traders are coming into the market at that point. So when we're not around these areas, when we're not around major swing points, all right, when you just look at the first areas that you are drawing attention to, when you're not around these areas, okay, when we're not close to them reasonably, all right, I will not take longer term positions, okay? And I will also not take longer term positions at the first test of these areas. I need to see that we either gain the area and then lose it, or just fail to do anything more than consolidate against it, all right, and then fail from that point. So what you're either looking at is either, you know, for example, just to draw this more accurately, I was looking at this area, okay, the lows, all right, of these structures. Okay, now we're at essentially the midpoint of a previous range, that range being right here. Ultimately, what is going to happen is either we're going to form a base back within this structure, and then, you know, by that, it's going to be an indication that there is strength on part of the buyers, or we're going to fail to maintain the structure. So we auction back into a previous range, and the failure is what is going to inform my longer term positioning to the downside. Okay, I'm not just blindly taking a position right here and, you know, sort of flipping a coin and hoping that we break down. I'm not just blindly taking a long right here and saying that, well, we've regained the structure, so that means that it's, you know, acceptance. What I need to see is that there is a clear imbalance in this case after a structure is formed. So what I'm looking at is some type of structure to form within here. Okay, so we're looking at this range. Ultimately, what I'm looking at is a structure to form above 6,900, 69, 6,800. Obviously, in an illiquid asset, we can't be that precise and talk in laser-like terms, and I just mean laser-like position, not to be corny. But ultimately, what I'm looking for is a structure to form here on the higher time frame, and then a break in either direction from this structure that occurs and shows a major imbalance between buyers and sellers. Okay, so that you're either going to have a consolidation, a base form, because one of the things that I talk about is, did the market form a base? You're going to have a consolidation form. You're going to form a base. There's going to be an imbalance break to the upside. It's going to be supported by delta and volume, or the exact opposite case is going to be painted to the downside. All right. And then because of our relative location, I'll be able to say, all right, reasonably so, my stop will be back within this structure. I'm going to be using this to define my risk, I'm going to probably be targeting a lower point within the structure. I'd say reasonably 5,800 initially, right? I'm not going to be looking at a lower time frame level that I have at this point because we've lost a higher time frame zone. Okay, so just keep that in mind. All right, higher time frame evidence does trump lower time frame evidence, but when we're not within close proximity to a higher time frame area, you're more or less you're in that coin flip zone. Okay, if you were looking at this and saying that this was a higher time frame range forming, anywhere that's closer to the middle of the distribution, all right, so ultimately what we would need is for this to come back down to form a more balanced range, but the middle is sort of fair value. Okay, so in between two extremes is fair value. All right, in this case, just a loose interpretation of fair value because, again, we haven't painted a range to distinguish that. If you did take, for example, if we did take a volume, all right, analysis of just this structure, okay, you see how this is not very balanced, but you would see that, for example, the value area, okay, is right here. So fair value distribution occurs down here. Again, in terms of looking like a balanced distribution or a bell curve, right? Something like that. It doesn't really look like that right now. Okay, but if you're operating within this area and looking for higher time frame positioning, unless you're really close to a key area, in this case, a market structure that it breaks down. In this case, you're looking at a daily area and we're talking about weekly structure, but still fair value is fair value, right? There's less certainty and it's just not, again, it's a suboptimal area to be defining risk for higher time frame positioning because there's a lot of things that can happen within here before you're either, continuously resume to the upside or continuously resume further downside. And there's just way too many cases where you could be thrown out of position from a psychological standpoint and from a, just a stop placement standpoint where you define your risk. Okay, so you'll either be mentally taken out of the position or chopped out of the position multiple times from where you define your risk within the structure. So now we are within relative proximity. Okay, I'm using that word too much, to higher time frame market structure. Okay, we've been accepted somewhat back within this range. Okay, so you can see that based on where we are currently, we're back within this range. All right, but I do need to see a base form within the structure to identify that we have put in meaningful market structure. All right, and that's just my way of saying we have established some type of platform. If you look at this, and I hate to see this drawing, it's on Twitter way too much recently, because you could continue to just do this upward, right? We did this earlier. You had this sort of triangular structure forming, and then we just treated the top of that as support. You could just continuously redraw this, but ultimately what you're looking at is you're looking at price funneling and compressing towards the highs. Okay, so the major top side of this structure was right here for the longest amount of time. Okay, we're talking about extremes, all right? So you can maybe identify ranges within here, right? This is obvious. You could see areas within here where there was consolidation, but the major top side was the top side of the structure over here. The move that we've had up has been not that impressive, right? We're still consolidating against a major area of market structure. This is a little bit alarming right now, though, because consolidating at resistance is not necessarily the thing that you want to see. You want to see that when you approach resistance, there's a firm initial shock. Right now, we also do have funding that has been negative for the duration of this structure, indicating that positioning on the derivatives platforms has been predominantly aggressive towards the downside. Remember that there's a long for every short, but there's not, there is a matching of an aggressive order with a passive order. So aggressive positioning has been to the downside with exception of this portion of the structure, okay, or to this portion, because the premium, rather in this case, the discount between, or it is a spot premium, has begun to close towards the top, okay. That was also, though, I would say a function of illiquidity down here, though, okay. So MEX was not nearly as liquid down here as it is now returning to this portion. Rather, what I mean is that we're returning to periods of greater liquidity towards the top side of this structure. Okay, excuse my sometimes lost, I pull a Joe Biden. All right, and I don't mean that as an insult because that's mean. So what we're looking at is compression price action. Okay, it's occurring at a major area of market structure. I still need to see more action from where we currently are. All right. Ultimately, what I would want to see for a long is some type of base form, okay, at this structure over here, at the top side of this structure. Okay, this being the poke upward into market structure previously, a base forming, and then again that aggressive imbalance to show that no buyers are in control. Delta volume are confirming this, because right now you do have volume that is dropping off for the structure. So volume has been on a decline. It's probably a better idea if I stop drawing that and just point that out. Okay, volumes as a whole, okay, have been on the decline, with slight jumps in volume obviously for the green days, but as a whole we've been declining. Okay, so this is, we're at that key inflection point, I'd say. All right, where I need to either see what I'm thinking is likely going to occur. Okay, as we get a pop upward and then we break down from there. All right, that's what I expect to occur, and I need that to occur before I take any longer term positions. I need this area to either fail, okay, or start to build. All right, I need to see we either build a structure down here and then leave it on an imbalance, okay, or we try to gain higher and then fail and then break down below these lows. All right, at that point we have lost this trend line. Okay, we've lost the structure that we've incrementally built on the way up, and it's just, the idea for me is that there's a ton of liquidity, and the first areas that are really obvious are these areas that your eye is drawn to. I just imagine there's a ton of stops down here that are just waiting to cascade. Okay, but I'm not going to be trading that feeling. I'm ultimately going to be trading my position is going to be dictated by the market's actions, all right, not my beliefs. So intraday positions were dominant up until this point. Now I'm looking for a longer term position. What I mentioned today on Twitter, okay, that the markets do not always reflect fundamentals. Okay, they have been, for the longest time, people have been making this argument that the fundamentals are not sound. All right, the market was due for a pullback, but you've had people on FinTwits calling for, recessions and depressions, and not depressions, but major declines for the entire bull market, with exception to right now, though. So we do have, across the board right now, we do have bounces. All right, markets are tremendously oversold. All right, stocks are insanely oversold. You have the Fed backstopping pretty much everything, so you're helped by this sort of policy assistance, and there's been, across the board for the last 2 weeks out of the last 30 days have been within the top 10 days in history for the Dow Jones. Okay, there were 2 other times where that occurred in such close proximity, and it was within that period. It was about, I think it was 6 weeks, and that was in 1933, and that was at the end of the Great Depression. So did we just fast forward through the shortest depression in time? I don't think so. I think that this is just what we're seeing right now is a squeeze. We're seeing the Fed try to throw every single thing at the market that it can, and we've seen advanced decline. Okay, advanced decline is a measure of market breadth. All right, so this is the difference between the number of advancing options, or advancing stocks, for example, or equities, and declining equities. All right, and you want to see that this supports market activity. So you want to see that when the market is moving up, especially in indices, you're going to look at the indices. You're going to look at an index such as the S&P 500, or look at the Dow Jones. I'd say the S&P 500 is the best representation of this. But you want to see that this is confirming the movement in the market in that index. Okay. We've had a pretty large disparity so far between this high, the local high, and the advanced decline. But again, market was very oversold. All right. You don't need to just go off of that to know that right now fundamentals are very detached from actual price. So when I made that tweet this morning, I meant that the arb that exists is probably to the downside. Okay. The market, I don't think, is just going to go into a bear market in a period of 20 days and then just V-shaped reversal. What we're looking at right now is the help of the Fed. We're looking at major short squeeze. Okay, if you look at the assets across the board today, banks, for example, banks especially responding positively to that Fed news. All right, that stimulus. You had AIG, Wells Fargo, Citibank, Bank of America, JP Morgan. These are all up over 7%, right? Market today was up, just under 2%, 1.45%. Don't know why I couldn't get that out. The Dow Jones up just over 1%, and you had banks up, financials up anywhere from 6 to 8%. You had companies like Gap, American Airlines, okay, which cut production. All right, by all means, release negative news. Okay, if anything, American Airlines, they essentially, they're meeting their demand at this point, so cutting flights to meet demand, and those assets over 10%. up over 10%. Now they are higher beta, so they're going to move up more than the index, but everything is just detached right now. Okay, prices are detached from value. We know that this is not just a small blip on the radar. Okay, so unemployment, jobs numbers being just to say terrible would be an understatement. Okay, everything is just looking extremely poor. Today's jobs report. All right, Thursday being a big day for the market. It's again big day for bad news, but the market seems to respond positively. We're looking at a slight, I think it was a slight decrease from last week's actual numbers, but again, just an insane number. Came in above expectations again. Okay, consensus slightly above consensus, right? The one positive thing that I would say, all right, that is one of the things that we want to look at right now across all asset classes for all markets is COVID data. Okay, so COVID cases worldwide beginning to plateau. I'm paying attention to New York, right? New York being the metropolis, pretty much Gotham City, the capital of the world. All right. The most cases in the United States, most deaths, and New York cases plateauing. Now, deaths are not going to plateau. You have people that are in hospitals that are still going to pass away. If anything, deaths can still go up and cases plateau, but we want to be paying attention to these cases, right? So I am looking at things like this to inform my bias for equity markets. And not for nothing, Bitcoin has been pretty damn correlated, all right, to the index. Okay, and I'm referring to the S&P. All right. Gold buyers right now, not buying it. All right. Gold buyers are not buying this whatsoever. Okay. We see that gold is on its way towards looking like it's testing out the all-time highs. So right now, I think that Bitcoin, of course, it's in a unique place to really benefit from a time like this. Okay. Maybe you could take a lesson from gold, but we need to see that reflected in price action. And if anything, the correlation between Bitcoin and equities for the last day, it hasn't really been there. So the positive performance we've seen in the S&P for the last 20, if we're looking at the futures, for example, I'm looking at the ES for the last 24 hours, has not been really apparent in Bitcoin, beginning to look like we're losing a little bit of steam. But I would just be careful with this right now. My bias is that we have liquidity below, or that's not my bias, but I think that we're going to roll over and test out lower prices, but I'm not taking that position, and I'm not assuming that that's going to occur and entering into position early. It just, this is the one asset to really just blow. It's the one asset to really surprise you, and if anything, that is the norm. So to say that Bitcoin, so if you told me next week that Bitcoin would be at 9,000, all right, if I woke up tomorrow and Bitcoin was at 9,000, I'd be like, yeah, you know what? Should have seen it coming. It's Bitcoin. So right now, again, most of my trading is going to be on an intraday basis. All right. And that's that. I think that pretty much covers it. Just as a reminder for everyone, Josh and I partner with Phemex. Tomorrow we are going to be doing a live stream where we pretty much go over every single thing about this platform. There are videos out there talking about just getting into position and getting out of position. I want to talk about more than that. I want to talk about derivatives. I want to talk about what makes this contract unique from a convexity standpoint. And hint, hint, this will tie into why you just absolutely have to use stops if you're in longs. And I won't say any more about that. But tomorrow the live stream is at 2 p.m. New York time. So feel free to send me a message. Let me know that you're going to be in there. I'm going to be taking questions. It's going to run its course for as long as it needs to make sure that everyone's questions are answered, because that's the problem. There are people that are on these platforms that are inexperienced traders and investors, and they don't know how to properly not only get in and out of positions, but use the tools that are afforded to them to give them the best possible advantage. The exchanges aren't in business to make sure that you make money, all right? But there are tools available that more often than not, traders are not taking advantage of. So we want to make sure that we go over those. And I think that pretty much covers it. I was just thinking, if we talk about the distribution of price through time, and one of the ways that we describe trading this is auction market theory. Okay, when there's a value area for price, right? We look to take advantages of the times when that is far away from value, when there's a large disparity between price and value, right? So we're looking to take advantage of that sort of mean reversion process, or we're looking to take advantage of the breakout from there. That's what we have right now in traditional markets. Okay, we have a traditional market that has far exceeded value. All right, so if this is your value area for traditional markets, right now we are all the way up here, in my opinion, right? Here's the fundamentals, here's the value area high, okay? And right now we are very detached from that, and we would trade the same way we would trade that if we were trading the lower time frame. We'd look to take advantage of that disconnect and sort of arb that difference. And I think that that's what we're going to see occur. One of the things we just have to remind everybody is that this has only been, we're looking at since the so-called local bottom right now. I don't want to say so-called because, very well this could be the bottom, right? But the bottom ends up likely playing out over a period of time, okay? But since then, it's only been 3 weeks, right? So this is still very recent. And there's a lot of things that will likely be developing over the course of the next few months that will probably be pretty negative. We're going to see some really horrible stuff. These are people's lives and jobs that are just, you have to think the course of their lives has dramatically changed. And if you're lucky enough to be a trader and to be able to step into the market every day and leave with something, then you're blessed in a sense, right? But it's not for everybody. So hopefully, if anything, BlockRoots is not going to make everyone a trader, but hopefully we give you an opinion that is worth taking along with the opinions of many others, right? So that, and hopefully, the little things that we give you, the sort of little nuggets of wisdom, hopefully one thing kind of turns a light bulb on, and you use this not to be the sole thing that you pay attention to, but to inspire you to get more involved on your own. Because in my opinion, that's the best way to learn anything, right? You find something that inspires you, it piques your interest, and then you really just go about the process in the same sort of, by osmosis, by immersing yourself in this material and learning it through your own trial, right? The hope is that you don't lose everything multiple times over in this process, and that's what education is for. So that's that, guys. Hopefully this has been informative. Remember, tomorrow's live stream is at 2 p.m. New York time. Hopefully everyone is healthy and doing as best as possible in a time like this. Again, those cliches, they are the truths, right? We do wish you well, but we understand that there are people that are suffering more than others right now. And if there's anything, reach out to myself or Josh. I would be more than happy to listen to what you have to say and offer, what I can offer that's not financial advice, obviously, if it's just a friend, right, in a time like this. So sometimes people just need people to vent to. All right? Everyone have a fantastic weekend. And that's that. As always, guys, exercise proper risk management and trade effectively.